everyone, I am Kim Hughes, and thank you so much for joining me for the Sane Crypto Podcast, the first cryptocurrency podcast for baby boomers investing for retirement. Go to sanecrypto.com/retirement to sign up for my free online training, how a little bit of Bitcoin can make your retirement savings go a lot further. As we have for the last several weeks, I'm going to tackle one of your questions from the Ask Kim mailbag. This one came in a few days ago from Mike. He writes, "Hi Kim, how did you do today trading crypto? I have Bitcoin and other altcoins and I'm way down. So tell me, how do you make money owning it? Thanks, Mike." Well, thanks for the question, Mike. This is a seemingly simple question, but there is an awful lot to unpack here. So let's dive in. And first of all, and I say this with all due respect and sympathy for Mike, the question itself indicates a fundamental lack of understanding about how markets work and how to invest in them. And sadly, this is the fastest way I know to lose money. Listen, you are playing the greatest game in the world against some of the brightest minds in the world, including these days AI, for real money, potentially big money. And yet, so many people try to play this game without even so much as understanding that the game that they are playing. That is crazy to me. I mean, sorry, and again, with all due respect, but really, what are you thinking? Because let me ask you something. What do you think your odds of winning would be if you played a game of chess where you and your opponent both put $50,000 in the pot? Winner takes all. And you don't even know which pieces can move where on the chessboard. Your opponent, on the other hand, has been playing tournament chess for 20 years. Would you play that game? Of course you wouldn't. But that is effectively what you are doing when you invest money and you don't understand the investment game. The very first thing you have to know is it is not the market's job to make you money. The market's job is to allocate capital. And the fastest and easiest way it does that is by taking it from people who don't know what they are doing and giving it to people who do. I do not care what anyone tells you. There is no such thing as freaking magic internet money. So, my first piece of advice is, if you are not willing to devote the time to learn how to play the game, get out now. And I'm not talking about, learning about the various blockchain projects. I am talking about if you are going to expect to make money from investing, whether it is in pork bellies, gold, silver, stocks, bonds, or Bitcoin, then learn how to play the game. Or people like me and millions of others like me are going to win every single time. And I'm sorry if that is harsh. It is meant to be tough love. And it will save you a lot of heartache and losses that you probably can't afford to take. And then, whining about how cryptocurrency is a scam. Investing is a scam. Cryptocurrency isn't a scam, although there are certainly scammers in both. You didn't bother to learn the game that you were playing. For more on that, I'll just point you to a previous episode of this podcast. It was number 13, titled, "Should You Pay for a Cryptocurrency Investing Course?" Which I will link to in the show notes. Okay, so with that out of the way, let me try to answer the question, even though it's probably not the answer to the question Mike thought he was asking. First, when we're investing, we always start with the end in mind. What are we investing for? What is the purpose of this money that we are investing in order to acquire? And over what time frame is it needed? The biggest reason people invest is to be able to support their desired standard of living if they can't or don't want to work. This is my definition of financial freedom, to be able to do what you want, when you want, without having to worry about how you will pay for it. Now, for most of us, if you think about it, if you had a trust fund, or we all had guaranteed lifetime income and guaranteed health care, we wouldn't need to invest, right? There wouldn't be a lot of point to it. But most of us don't have that. And therefore, one of our biggest financial jobs over our lifetime is to accumulate enough money to be able to pay our bills and support our families in the event we can't work, don't want to work, and for however long of a time frame that needs to cover. In other words, you don't want to be 92 years old living under a bridge eating cat food. For most people, certainly most people in my audience, that is why they invest. So with that information, right, with the end in mind, you want to match your investments to your time horizon and your tolerance for risk. Meaning, you never want to take any more risk than is required to get the necessary return over the necessary time period. But of course, that presupposes, that you've thought about that in advance. You're not just investing, throwing money against the wall willy-nilly, okay? Now, in any investment, the longer your time horizon, the more likely you are to make money. The more patient you can be, the more likely you are to make money. The shorter your time horizon, the more likely you are to lose money. And fundamentally, you have to understand that profit is the reward for risk. All right. So that combination of time horizon, risk, and expected rate of return allows you to place all investments somewhere along a risk-reward continuum. At one end are things like cash and short-term bonds. At the other end is cryptocurrency. And the stock market, real estate, other investments are somewhere in between those. So if, for example, I was investing my 16-year-old's college fund, I would not invest that in crypto because she's going to need that money in just a couple of years. And I know that cryptocurrencies can go for years with negative returns. Same for the stock market. So in that case, I would have that money in something safer with a shorter time horizon, like short-term bonds. But the trade-off, of course, is safer, so I make less. Now, if I'm saving for retirement, well, this is money that I'm going to need to tap periodically over really long periods of time. And in order to build a big enough nest egg, I'm going to have to get average returns of probably 10% plus over the lifetime of that portfolio. So while the stock market may go for years with negative returns, those are called bear markets, right? Over the longer time horizon of a retirement portfolio, which is 30, 40, 50, 60 years in some cases, its expected rate of return when you average those ups and downs is about 8%. And so that is consistent with the time horizon, the risk, and the required return of a retirement portfolio, which is why you typically see a large percentage of retirement portfolios allocated to the stock market. So that brings us back to Mike's question, right? Again, remember, he said, "Hi, Kim, how did you do trading today? How did you do today trading crypto? I have Bitcoin and other altcoins and I'm way down. So tell me, how do you make money owning it?" Okay, so first, I don't trade crypto or anything for that matter, even though I actually cut my teeth as an options trader back in the late 90s. That is a game that is rigged against you 5 ways to Sunday. I promise you. Even though lots of people make lots of money promising to teach you how to trade, you will lose money. I guarantee it. Look, it's so seductive. It always has been, because it looks like it should be so easy. But this is our brains tricking us. Our brains are explanation machines. So with hindsight, it seems like what is luck or coincidence is skill, or that we can see patterns and randomness. For more on this, I would point you to my interview with Nassim Taleb in episode number 4, where we talk about his book, Fooled by Randomness. World Series of Poker winner and neuroscientist Annie Duke, she has a great litmus test for this, a great way of understanding it. She says, if you can lose on purpose, it's skill. If not, it's luck, right? So how do you make money from cryptocurrencies when every day they are going down? Well, the answer, Mike, is you don't. You don't, right? That's what I've been leading up to all the way to this point, which is why you don't own just crypto assets, because on their own, they're far too risky. The way to lessen that risk and lessen the anxiety when they are losing value is by holding them as part of a basket of what we call uncorrelated assets, each serving a different purpose. Now, I cover this in some detail in my free online training program, which is how a little bit of Bitcoin can make your retirement savings go a lot further, which, again, you can join at sanecrypto.com/retirement. But basically, modern portfolio theory says that diversification reduces the overall portfolio risk. There's a reason someone won a Nobel Prize for that. A very inconvenient truth when it comes to investing is that trees just don't grow to the sky. Nothing goes up in a straight line. Nothing. If it did, the risk would be zero, and therefore the return would be zero. And remember what I said earlier, profit is the reward for risk. That's a fundamental way of understanding market pricing. If you look, going back to 1929, the U.S. stock market has experienced a bear market decline on average about once every 5 years. As we would say in the crypto world, it's not a bug, it's a feature. In Bitcoin's very short history, going back to 2012, there have already been 5 bear markets, including one that lasted over 3 years. So, basically, in spite of the eye-popping returns, Bitcoin has spent most of its life going down, not up. Interesting, huh? If you look, I think it is something like 30 of the trading days in 2017 accounted for 85% of that 1,033% total return of Bitcoin last year. That's what we mean by risk. It isn't that it doesn't go up, but it goes up erratically and with very long periods of negative return. And the more erratic the return, the more risk something has. So if we want to be the beneficiary of those sorts of returns, it means we have to expect and manage that risk. And there's really 2 ways we do that, okay? One is in our portfolio and one is in our head. In our portfolio, it's by holding multiple asset classes, right? Things like stocks and bonds, real estate, commodities, and yes, crypto, that tend to go up and down separately and serve different purposes or do different jobs in our portfolio. Those jobs are cash flow, capital gains, and hedging risks, okay? So that's how we manage the ups and downs of our investments in our portfolio. But how do we manage the ups and downs of our emotions? Well, Here's what I'm going to tell you, and you're just going to laugh and think it's crazy, but it's not. It is this. Don't check prices. Don't look at your portfolio. Don't read the news. Don't read crypto Twitter. Don't participate in chats or communities or otherwise pay attention to your investments or the markets. This is so hard for most people. But I can tell you it is not only possible, it is a necessity. I've been doing it for almost 30 years. Even as a professional portfolio investment advisor and portfolio manager, I never looked at where the market was. I rarely knew where it was, whether we were in a bull market or a bear market. It was only at the extremes I knew, and usually that was because of the phone calls I was getting from clients. There is absolutely nothing good that can come from taking in that information. It only fuels fear and greed, and fear and greed cause you to do the exact opposite of what you should be doing, which is to buy low and sell high. Instead, fear causes you to sell at bottoms, and greed causes you to buy at tops. So, the idea here is and this, granted, for a lot of people is a big if, but if you have constructed your portfolio thoughtfully and consistent with your time horizon and risk tolerance, there should never, ever be a time where you will react to prices, events, or news. Let me repeat that. A successful investor never, ever reacts. This is the value of a system. If you're just winging it, then you are making emotional decisions, not logical ones. Successful investors always have a system. And that system should determine 5 things. 1, whether we should be invested in a particular asset or not. 2, how much of the portfolio to allocate to it. 3, under what conditions do we buy it? 4, under what conditions do we sell it? And 5, under what conditions would we buy more? Now, again, in the free training I do, you'll see these 5 questions and, more discussion about what a system is and, and why it's so important. But have you ever heard an investment manager use the term edge? Their edge. So in order to outperform the market, which statistically is extremely hard to do. What that means when I say outperform the market, that means if Bitcoin got 1,033% return last year, how many investment managers were able to do better than that? If we assume Bitcoin is the proxy for the market. In the stock market, S&P 500 is the proxy for the market. So if the S&P was up 9% last year, how many portfolio managers were able to get better than that for their clients? That's what we mean by outperforming the market. Because I could just buy an S&P 500 index fund and be the market and get right? So if you're going to pay a manager, the only reason you'd pay him is because they think they can do better. And statistically, most of them don't. 98% don't, and they're different every year. It's extremely, extremely hard to do. But what they are looking for in terms of how they think they're going to do that is what they call an edge. And that is a little tiny advantage that they can use or leverage that's unique to them to be on the positive side of the zero-sum game more often than the losing side. Because again, remember, investing is a zero-sum game. The only way I make money is by taking it from someone else, okay? So my edge is my system. It is the ability to not react emotionally, to be able to trust and follow the system no matter what. No such thing as extenuating circumstances. Never. That's what I did on September 11th. Didn't budge, right? Exactly as if it was any other day. It's what I did during the financial crisis. It's what I do every single day. And I'm right, because if you think about it, every single time that you have caved in to fear or greed has been the exact moment the market turned, hasn't it? Right? The moment you sell, that's the bottom and it turns around and goes up. Or the moment November and everybody was talking about how much money they were making at Thanksgiving and you finally get in crypto and that's the market highs, okay? So let me just summarize, okay, my answer here. There's 5 pieces to it. One is don't play a game with serious consequences for money that you don't understand. Number 2, trees don't grow to the sky. There is no such thing as an asset class that goes straight up. Every single asset with any return potential has periods of loss, sometimes long, and in the case of crypto, more common than not. Number 3, you manage that risk, those market declines, by making crypto a small part of a diversified portfolio matched up to your objectives, your risk tolerance, and your time horizon. Number 4, you decide what you're going to do and when while you are sane, and then you stick to it no matter what, no deviation, no guessing, no extenuating circumstances. And then number 5, set it and forget it. Do not tempt fate. Don't fuel fear and greed by watching news or checking your portfolio or checking prices. There is absolutely no reason, because remember, you're not going to react. Besides, once it's happened, it's already too late anyway. So I hope that was helpful for you. Thanks again, Mike, for your question. If you did find it helpful, you could do me a great big favor in return, which is one, to subscribe to the podcast. Believe it or not, well, you'll probably believe it. The iTunes algorithm actually dings us for people who download the podcast but don't subscribe. And even better, if you would also leave the podcast a review on iTunes with comments and feedback. I do read those and they are so helpful to me, but they are also helpful because they will help me crack the top 100 list for investing, which is what I am working on. That's my goal, so that we can get found by more people. So if you feel the urge, I sure would appreciate that. And again, if that piqued your interest and you'd like to learn more from me about investing in crypto assets for retirement, I would encourage you to register for my free online training, How a Little Bit of Bitcoin Can Make Your Retirement Savings Go a Lot Further. You can register for that at sanecrypto.com/retirement. And you will also find the full show notes for this episode at sanecrypto.com/podcast, with links to some of the podcast episodes I referred to, links to all the charts and the graphs and the articles and the statistics that I quoted from, and a bunch more. Again, just to reiterate, the free online training is sanecrypto.com/retirement, and the show notes are sanecrypto.com/podcast. And finally, if you have a question about today's topic or really anything else, just email me at askkim@sanecrypto.com like Mike did. I read and answer every email personally, as well as answer some of them here on the show. And speaking of this show, everything I say on this show is for educational purposes only. Nothing should be considered investment advice. Past performance is no guarantee of future results. All investments involve risk, so do not, under any circumstances, invest money you can't afford to lose. That is it for me. I am Kim Hughes. I'll be back next week. Until then, may the crypto gods continue to smile on us all.